central bank policy pyrotechnics of the past fortnight, we've a slightly quieter week ahead of us, at least from a macroeconomic perspective. The biggest feature here, on the domestic front at least, is likely to be the release of the latest UK Consumer Confidence Survey from consultants GfK, and that's due on Friday the 27th of September. Now in August, the headline reading dropped 3 points to -14, equal to the low seen in summer 2013. The major purchase reading also fell 3 points to +1. Now it is possible that the political deadlock over Brexit had an influence here, but it will be interesting to see if rising wage growth starts to give consumers a bit of a lift. Remember that the latest batch of data from the Office for National Statistics showed total wages, including bonuses, grew at 4% year on year in July. That was a 10-year high, and it comfortably outpaced the latest headline inflation figure of 1.7%, so wages are going up in real terms. Now we all know that the past is no guarantee for the future, but this chart suggests that consumer confidence starts to rise a few months after real post-inflation wage growth starts to accelerate. It hasn't really, however, happened this time, at least yet. Now if, and I stress if, real wages and confidence improve, the next question is whether this filters through to retailers and then their share prices. Given all of the commentary surrounding the fate of the high street, consumer gloom, Brexit and everything else, it may surprise you to learn that the general retailer sector as a whole is up by 14% this year. That beats an 8% gain from the FTSE All Share. Maybe this reflects that improvement in real wages, but that still needs to continue, and even then, it would still leave investors to fathom which retailers are getting it right when it comes to providing the right product, right price, and doing so in the most convenient manner for their customers. Company-wise, there is a deluge of interim results from the UK's mid and small cap brigade, with a smattering of trading updates from larger caps thrown in for good measure. Firms which could be worthy of note, either in their own right or because they offer some insight into the current industry or macroeconomic trends, include white van supplier Northgate on Monday the 23rd of September, travel agents TUI and Thomas Cook, real estate investment trust Town Centre, card retailer Card Factory, and fizzy drinks maker AG Bar on the 24th. Two more retailers, Boohoo.com and Joules on the 25th, intellectual property incubator Allied Minds on the 26th, and utility and Pennon and veterinary services expert CVS on Friday the 27th. But for me, the stock most likely to cause a big fuss in the week ahead is water and wastewater services specialist United Utilities. The FTSE 100 member is set to release its first half trading update on Wednesday the 25th of September. Now we know what you're thinking, utilities. Boring! But as we can see here, United Utilities shares are actually up over the past 12 months. Now that may seem a bit surprising, especially as the gas, water and multi-utility sector overall is down by around 2% this year over the last 12 months. That leaves it ranked 36th out of the 39 groupings in the FTSE All Share. Now that poor showing owes a lot to Centrica's dividend cut and its relentless share price slide, but also it's due to concerns over what any Labour government might do should Mr Corbyn and Mr McDonnell get into power, and also there's the issue of regulatory scrutiny increasing as well. But the regulatory cycle for the water industry may actually be one reason why United Utility shares are doing relatively well. This is because back in January, the industry regulator, Ofwat, approved and fast-tracked United Utilities business plans for AMP7, the next regulatory cycle that runs from 2020 to 2025. United Utilities was just one of 3 utilities to get this. The other 7 were sent back to the drawing board. So when it comes to this trading update, analysts will be looking for any further comment on AMP7 and United plans for it, which the firm has already quantified as offering its customers in the northwest of England a 10.5% real terms post-inflation price cut over the cycle. After that, attention will turn to any comments on the financials from Chief Executive Steve Mogford. For the full year to March, analysts are looking for a 2.8% increase in revenues, so that seems a fair benchmark for the first half. A year ago, first half sales came to £916 million. In terms of operating profit, analysts are looking for a high single-digit percentage improvement for the whole year. So again, That seems a fair test for the first half. However, do note that the interim numbers last year were hit by £25 million in costs associated with a hot summer. Strip out those costs and some restructuring, and the underlying first half operating profit was £368 million, while the statutory one was £339 million. They're your benchmarks. Analysts and the regulator will then turn to capital investment. This came to £303 million in the first half a year ago, and United Utilities is increasing spending in preparation for AMP7. Now, in the unlikely event that United Utilities is discussing its dividend, it'll probably do that at the full interims, analysts are looking for a 3% increase in the full year payment to 42.5 pence a share. Again, that rate of growth seems a fair benchmark for the first half, when United Utilities paid 13.76 pence a share a year ago. The last cut in the dividend, by the way, came in the year to March 2011, since when the payments increased 8 times in a row. And as a final point, if that 42.5p a share forecast is met, by the way, that would put the stock on a forward dividend yield of around 5.4%, enough to rank it 40th in the FTSE 100 buy yield. Thank you for watching, and I look forward to seeing you next time.